Okay, so welcome to my recorded session on the introduction of the new Income Tax Act 2025 here in Papua New Guinea. Okay, to understand the context of the new act, let's go back and see the old act, which is way back 1959 before the independence of Papua New Guinea. Uh, and the old act has more than 500 pages with 369 sections. And now the new app goal is to make it modernized, simple, and to align with the international practices or best practices. The reform started from Sir Nagora Bogan's or late Sir Nagora Bogan's tax review recommendations in 2015, and in 2017 there was a medium-term revenue strategy from the Treasury Department. And then after that, getting these recommendations and the revenue strategy, which has a goal of increasing the revenue within 4 to 6 years, they drafted the Income Tax Act between 2024 to 2025, and the new act, now will be applicable starting 1st January 2026. Okay, so key structural improvements. There was a consolidation of that of the administrative provisions, which moved to Tax Administration Act, and in the new act or the Income Tax Act 2025, you can see that there is a section for tax administration procedural guidelines. And from 500 pages, it now went down to more than 100 pages. And from 369 sections, we only have 165 sections. So as I mentioned, it will start on 1st January 2026. So there's a grace period. So January to March, that will be like the transitional compliance. Of course, there will be certain entities that may have difficulties to comply right away. So they provided grace period. And the old act applies to accounting periods starting before 2026. So which means, for example, if the company's commencement or starting of the year or financial year will be on 1st July, the old act will still apply, okay, because their year end will end on 30th June. And then so some key improvements. We have on the employment income basics, that of course that will include wages, salaries, bonuses, and non-cash benefits. Retention of salaries and wages tax, of course, will remain as final tax for most. Okay, and the rates that provided since 2023 for individual wage earners will remain the same. Okay, and it's codified as part of the Income Tax Act 2025, the new act. Now, in salary packaging, it formalizes the 60% 40% rule or 60/40 rule. So part of the salary packaging will be, of course, 60% cash to be received by the employees, and 40% will be for the benefits. So this requirement must obtain a prior approval from Commissioner General. This includes school fees, leave tickets, and superannuation. Now, in motor vehicle, as you can, those who have studied taxation, the fixed notional value of vehicle, particularly if the fuel was provided, is 125 kina per fortnight. But now the new formula, that will be 10% of the vehicle's cost or the fair value, market value if leased, divided by 26, for of course 26 fortnights. For example, here if a car has a cost of 50,000 kina, which is used for personal use of the employee, so that will be part of the benefits. So 50,000 kina multiplied by 10%. So that would be 5,000 divide 26. Okay, fortnights. So the cost of motor vehicle benefits is 192.31 kina in this example. So this will be like an example. There will be a particular ruling that will be issued by IRC on or the explanatory note on this. For example, if the vehicle is used purely for business, so what will be uh, the treatment? Or if the vehicle is partly used, okay, for business and for personal, so how will be or how much will be the benefit? So there will be an issuance to be provided by IRC, but basically it may or will require you to maintain a logbook, okay, for motor vehicles. Now, in employee share schemes, there are employees who are paid or given benefits, which in forms of or in the form of share. Here, they included the specific rule on taxing the shares. The rule is that the shares will be, of course, taxable if the shares are granted or the restrictions are lifted. So what it means, there is no such hold on that shares or the shares is already been provided or granted, then the tax will be calculated. So the valuation or the difference between fair value, market value, and the amount paid by the employee, of course, that will be considered like cost or there will be like a profit. Okay. Another key points that we can discuss here, deduction for individuals. It's almost the same with the old act, and they still retain that 20,000 kina tax-free threshold. Now, in business and corporate taxation, this will be really quite interesting. In business and corporate taxation, self-assessment shift towards taxpayers determining their own liability. So that's the practice now. So they can do their self-assessment. In record keeping, enhanced requirements to maintain digital records, which of course in the old act have not been discussed in detail. And in methods, there will be a choice on accrual and cash basis, as same with the old act, but there will be a specific threshold. Now, in depreciation, there will be 5 classes of assets that you can classify. In the old system, we have 213. It's really quite long. If you look into that depreciation table, right now it's really simplified. So you just have to classify that within those 5 classification. And unlike in the old act, now the default method is a straight line. So this is the classification. As you can see, for example, class 1 will be computers and data equipment. That will be the rate will be high. Motor vehicles, light tools, general plant and machinery, buildings and structure. And the most interesting here will be intangible assets, because in the old act it's not clearly specified. So here, intangible assets, for example, patents, brand names, customer list, contract rights. So the amortization is 10% per year on straight line basis. Of course, goodwill is excluded. Okay, as we know, goodwill is particularly on business combination And consolidation, it only appears when there's an acquisition or consolidation of business commonly, so the 10% rule will not be applied. Loss carry forwards, another interesting revisions or revisions of the act. Of course, the general limit will be to 20 years, but you have to check for the specific schedules that also included in the act. Continuity of ownership, if you can remember that in continuity of ownership, uh, the changes should not be more than 50%. Okay, but if you can recall in the old act, we have two tests on carry forwards. Which one is same business test, and the other one is, of course, this one continuity of ownership. That same business test was not mentioned in the new act. Okay, group tax provision. Companies with 90% common ownership are part of that group. Okay. Now, this is another particularly interesting here. One profitable company can sort of buy, right, the loss of a sister company. What it means is that if they are considered in a group, if they are part of the group, one company can absorb the loss of another company. Okay, of course, we have limited time here, but how it works, and I want to explain it further. But how it works is that that loss can be absorbed by another company, but that loss should not be claimed by the company, which of course incurring that loss, which had been transferred to another company. Okay. All right. And another highlighted or key points in the new act is the capital gains tax. In the old act, we don't have this. Now, just give an overview of the capital gains tax here. This is the first time that we have that comprehensive CGT regime, and there are particular sections in the new act which will provide more information about this. So the rate that mentioned there is around 15%. Of course, the effectivity date will be 1st January 2026. So taxable asset for CGT or capital gains tax, resource rights, okay, resource heavy entities, shares in companies where 50% and up value comes from PNG resource assets. Another one is options, right, to acquire these two above. So the formula, quite simple. That gain will be, of course, the consideration provided or given up by the seller, and then less cost. So the cost base will be inclusive of purchase price improvements, and of course reduced by depreciation already claimed. Now, in the old act, if you have gain from selling and your property, okay, you have to wait till you lodge your income tax or annual income tax, then you will report that sort of like gain from sale that you earn from the sale of the asset. But here in CGT, it's transaction based. So which means whenever that transaction happen, you need to pay the tax. So the deadline will be aligned with the stamp duty timelines, and the liability will be, of course, for the seller, okay, who had, of course, sold the item and, of course, gained. Okay, so the responsibility of filing and paying the tax will be on the seller. The next major item that we can go through here, or we will be going to go through here, is international sector specific sectors. Taxation of non-resident. In the old rule, we have foreign contract withholding tax. Uh, But now we have, so if we treat a company, okay, this is particularly on company. If we treat a company and they will be falling under what we call permanent or will be having the permanent establishment classification, they will be taxed at 30%. But the profits that they repatriated to their home country, this is, take note, this is non-resident company, will be taxed at 15%, which is still consistent on the old uh, rule. But then again, that actually encourages, okay, more investment, okay, because before they're charging 48%, okay, on foreign or non-resident companies. Now only 30%. In effect, if you look at this, the tax will that or which will be deducted from the profit, so sort of the profit of the company or a non-resident company will be net of 40.5%. Okay, technical fees and royalties. So withholding tax on that will be from 17 to 15%. Okay, now it includes these royalties and technical fees, includes software, digital content, and equipment leasing. Now, in extractive industries, the ring fencing remains. Okay, so the way you understood the ring fencing before, it will be still be the same. With regards to additional profits tax, it was reduced from 15%. Now it's 13%. And with regards to decommissioning, they are allowing deductions for funds which sets aside for mine closure. If they are keeping some funds when they will decommission the mining or the mining business, then particularly the area that they're doing extraction, if they're setting funds there, then there will be a particular deduction allowed. All right, anti-avoidance rules. This is particularly on reducing the base erosion and profit shifting. Okay, so in transfer pricing, there will be a stronger provision on transfer pricing, simplified but stricter rule. On tin capitalization, there will be limits on debt to equity ratios, which prevents excessive interest deduction, and they had sort of like a reduced, okay, the ratio, okay, 2:1. Now in administration and compliance, new filing deadlines for individuals and trust 3 months after year end. Of course, that is 31st March. Companies 6 months after year end. But if your company has tax agent, that can go up to 9 months. Now, I mentioned about self-assessment a while ago. Okay, this concept is where the taxpayer return is deemed to be an assessment on the day it is filed. So the role of IRC here is moving from assessing every return to auditing high risk return. Now, in penalties, with regards to penalties, there will be a fixed penalty plus monthly interest. Uh, it's a strict one, okay, and rather than sorry, not rather than, but I would say some offenses will be having heavy fines, okay, regardless of intent. Now, in small business tax, they integrated the small business tax procedural guideline in the new act. Okay, they still retain the same. Okay, that low fix or 2% turnover minimal record keeping. So what they did in the new act, they just integrated the procedural rules. Okay, so how it impacts the PNG economy? Because the act now is clearer, it's easy for foreign investment, okay, to understood and not much complication. And that act is really short but comprehensive, comparing with the old act, which is there are more than 360 plus pages. This It provides fairness, okay, for both locals and multinationals, because you can see now that there's a 30% rate for companies as long as they qualify for that permanent establishment. And it also helps on better collection, okay, function for IRC. Okay, so you can see the link that I have posted here from IRC. You can download the new act. Okay, and if you wish to connect with me in LinkedIn, you can see that QR code. You can scan. Let's connect and have a much uh, closer discussion on topics not only on taxation but of course in other accounting and auditing topics. Thank you very much for your time and hope you learned something.